Tonight is not normal. The clock is ticking. Asian markets haven't even opened yet. And somewhere in the system, a pressure point is forming. One number, $80, not $79, not $81, just $80. Behind it sits a wall so large, one wrong move, one thin moment of liquidity, and the market doesn't move. It snaps. Banks know it. Algorithms are calculating it. And when this line breaks, there is no pause button, because once this starts, it doesn't stop where people expect. And by the time the world realizes what happened, it's already too late. Welcome to market metal. Now listen, and I'm saying this respectfully, like I would to someone wiser than me. If you've lived long enough to see cycles repeat, booms and busts, then you already know. When something feels this quiet, it's usually not. So before we continue, please subscribe to this channel, not for noise, not for hype, but so you don't miss the moment when the truth shows up before the headlines. And tell me in the comments, where are you watching from right now? Because tonight, this isn't just a chart, it's global. The setup. Why tomorrow is not a normal trading day. He understood that most trading days look the same on the surface. Prices move, headlines scroll, analysts debate narratives, and the market opens and closes without consequence. But some days are different, not because of news, not because of emotion, and not because of opinion. They are different because of structure. And February 6th, 2026 was shaping up to be one of those days. This was not a warning built on fear. It was not a prediction based on belief. It was an observation rooted in positioning, timing, and math. The kind of setup that exists quietly in the background, while attention stays focused on interest rates, earnings, and politics. By the time most participants noticed it, the decision window would already be closing. The market was approaching an options expiration cycle. An options expiration is not just a date on a calendar. It is a moment when obligations become real. Contracts that were once theoretical turn into actions that must be executed. Risk that was once deferred becomes immediate. And when exposure is concentrated, expiration does not release pressure. It forces behavior. At the center of this setup sat a single number, $80, not $79, not $81, exactly 80. That level had nothing to do with psychology or round number bias. It mattered because of how many derivative contracts were tied to it. Over weeks, participants across the market, retail traders, funds, and institutions, had accumulated call options betting on higher silver prices. That activity was visible, measurable, and unusually concentrated. A large portion of those bets shared the same strike price and the same expiration date. This was not normal distribution. It was a clustering of exposure. He recognized that markets do not break because of opinions. They break when incentives align in the same direction at the same time. Options are powerful, not because they predict the future, but because they force transactions when conditions are met. And the closer the market moves toward expiration, the less flexibility remains. The important point was not whether silver should trade higher or lower. The important point was that a large group of contracts would either expire worthless or convert into obligations within hours. That binary outcome mattered far more than any analyst forecast. What made this setup dangerous was proximity. As the night progressed, silver was trading just below the level that activated those contracts. The distance was small enough that normal overnight volatility could close the gap. There was no need for extraordinary news. No shock was required. A modest increase in buying pressure during thin liquidity hours could do it. This is where many observers made a mistake. They assumed that markets respond primarily to information. In reality, markets often respond to positioning. When too many participants are exposed to the same outcome, the system becomes fragile. Small inputs can create large outputs, not because demand explodes, but because risk must be managed. The mainstream discussion largely ignored this. Most coverage focused on macro trends, central bank policy, or industrial demand. Those factors matter over months and years. They matter far less over hours. Derivatives operate on a different clock. They compress time. They convert gradual pressure into sudden action. He had seen this before in other markets, not always in commodities, sometimes in equities, sometimes in volatility products. The pattern was consistent. A large options position builds quietly. Price approaches the strike late in the cycle. Liquidity thins as participants wait. Then, behavior changes abruptly. The reason was simple. The sellers of those options were not speculators. They were market makers. Their role was to provide liquidity, not direction. They sold options and hedged their risk dynamically. As price moved closer to the strike, their hedging requirements increased, not because they wanted them to, but because their risk models demanded it. This was the mechanical heart of the setup. As expiration approached, time value decayed. There was no room left to wait and see. If price crossed the strike, hedging would have to accelerate. And when many firms are forced to hedge in the same direction at the same time, the market stops behaving smoothly. That was why tomorrow was not a normal trading day. The risk did not lie in a belief that silver was undervalued or overvalued. It lay in the possibility that the market would be forced to act faster than its structure could absorb. That is how dislocations begin, not with panic, but with obligation. He also understood that timing mattered more than outcome. If the level was never reached, the pressure would dissolve quietly. The contracts would expire. The system would reset. No one would talk about it again. But if the level was reached, even briefly, the reaction would not be subtle. This asymmetry was what made the situation important. The downside scenario was uneventful. The upside scenario was disorderly. Markets are most vulnerable when the range of outcomes is uneven. He noted another detail that raised concern: the global trading sequence. Asian markets would open first, followed by Europe, then North America. Liquidity would build gradually, but the earliest hours would be the thinnest. It would not take much volume to move price during that window. If a large participant chose to act early, the effect would be magnified. This was not a claim that someone would act. It was an acknowledgement that the structure allowed for it. He also knew that many decision makers underestimate derivatives because they are abstract. A futures contract or an option does not feel real until it forces a trade. But by then, the opportunity to prepare has passed. Those who manage risk professionally do not wait for confirmation. They study exposure in advance. That was the purpose of this analysis, not to predict, but to prepare. To explain why attention should shift away from narratives and toward mechanics. To clarify that the next session carried structural risk unrelated to opinion. Tomorrow's importance was not about silver alone. It was about what happens when markets rely on instruments designed for efficiency rather than resilience, when liquidity is assumed rather than guaranteed, when algorithms execute rules faster than humans can respond. He concluded that the question was not whether something dramatic would happen. The question was whether the system had enough room to absorb forced behavior if it did, and that question would be answered very soon. In the next part, the focus would move away from timing and toward mechanics, because understanding why the pressure existed was only the first step. Understanding how it would express itself was what separated observers from decision makers. The mechanics, how the call wall forces the market to act. He knew that suspense in markets does not come from mystery. It comes from inevitability, from understanding that once certain conditions are met, choice disappears. The system stops asking what participants want to do and starts demanding what they must do. That was the uncomfortable truth behind the call wall sitting at $80. Most observers think of options as side bets. They imagine traders making directional wagers, winning or losing, then moving on. That view misses the central role options play in modern markets. Options are not just bets. They are contracts that transfer risk. And when that risk concentrates, it reshapes behavior across the entire market. At the center of this structure were call options, contracts that give the buyer the right, but not the obligation, to purchase silver at a fixed price before expiration. The buyer pays a premium. The seller collects it. On the surface, it seems balanced. But beneath that simplicity lies a complex chain of forced responses. The seller of those options was rarely an individual trader. It was usually a market maker, a bank or specialized firm whose job was to provide liquidity, not take directional risk. Market makers aim to stay neutral. They do not care whether silver rises or falls. They care about managing exposure so that price movement does not threaten their balance sheet. To remain neutral, they hedge. When a market maker sells a call option, they become exposed to rising prices. If silver moves higher, the option gains value and the seller loses. To offset that risk, the market maker buys silver futures. But they do not buy the full amount immediately. They buy proportionally, based on a variable called delta. Delta measures how sensitive an option is to changes in the underlying price. When silver is far below the strike price, the delta of a call option is low. The option barely reacts to price movement. In that case, the market maker hedges lightly. There is no urgency, but delta is not fixed. It changes as price moves, and that change is not linear. As silver approaches the strike price, delta accelerates. The option begins to behave more like the underlying asset itself. The market maker's exposure grows quickly. To stay neutral, they must buy more futures, not because they want to, but because their risk models require it. This is where gamma enters the picture. Gamma measures how fast delta changes. When many options share the same strike and expiration, gamma becomes concentrated. Small price moves near the strike cause large changes in delta. That forces rapid adjustments in hedging. The market maker is no longer reacting calmly. They are chasing the price. At $80, this effect was extreme. There were hundreds of thousands of call options tied to that single level, all expiring at the same time. Each contract represented control over thousands of ounces of silver. Individually, they were manageable. Collectively, they formed a wall of conditional demand. As price moved closer to 80, the hedging requirement increased. Market makers were already buying futures to offset risk, but that hedging itself pushed prices higher. Higher prices increased delta further. That forced even more buying. The process fed on itself. This was not speculation. It was a feedback loop. He understood why this was difficult for many to accept. It sounded circular. Buying causes buying. But markets are full of such loops. Liquidity provides stability until it doesn't. When too many rules point in the same direction, the market loses its ability to self-correct smoothly. What made the situation more dangerous was time, options. Expiration compresses decision-making. As expiration approaches, there is no benefit to waiting. If a market maker delays hedging and price continues to rise, losses accelerate. If they hedge early, they may push the market against themselves. But early action is often safer than late action. This creates a game theory problem. Each market maker knows the others face the same exposure. Each knows that if price breaks the strike decisively, everyone will rush to hedge. The first to act absorbs less damage. The last pays the highest price. In such situations, rational behavior leads to collective instability. This is how markets overshoot. The call wall at 80 was not a ceiling, it was a trigger. Once activated, it did not slow price movement, it accelerated it. The demand created was not optional. It was forced by risk controls, compliance rules, and internal limits. He also noted that this demand was disconnected from fundamentals. It did not care about mining supply, industrial usage, or economic forecasts. It existed solely because of contract mechanics. That made it powerful and temporary. It could appear suddenly and disappear just as quickly after expiration. But while it existed, it dominated. The scale mattered. The number of contracts meant that hedging demand could rival a significant portion of daily futures volume. And because this demand was reactive, it tended to arrive in bursts, sudden price jumps, thin order books, gaps rather than smooth trends. This was where suspense entered the equation. No one could know the exact moment price might touch the trigger, but everyone who understood the structure knew what would happen if it did. The market would stop being a place of negotiation and become a place of execution. He also understood why institutions rarely discuss this openly. Admitting that markets can be driven by forced behavior undermines the idea of efficient pricing. It reveals fragility. It suggests that stability is conditional, not inherent. Yet this is how modern markets function. They are efficient most of the time precisely because they defer risk. But when deferred risk converges on a single point in time and price, efficiency collapses into urgency. That was the power of the call wall. It sat quietly, invisible to those watching headlines, waiting for proximity. As long as price remained below it, nothing happened. The moment it was breached, the system's priorities shifted. The suspense was not about direction, it was about activation. In the next part, the analysis would move beyond the first trigger, because the real danger did not lie in a single wall of options. It lay in what waited above it. Additional layers of exposure, secondary strikes. A cascade that could transform a localized event into a broader liquidity stress. Understanding that cascade was essential, because markets rarely break at the first point of pressure. They break when pressure compounds faster than liquidity can respond. The cascade risk. When one trigger unlocks the next. He understood that markets rarely fail at the first point of stress. They fail when stress compounds. When one pressure point activates another, and then another, until the system no longer has time to adjust. That was the real danger hidden behind the $80 level. The first trigger was not the end of the story. It was the beginning. Above 80 sat more contracts. They were not as concentrated, but they were numerous enough to matter. Strikes at higher levels, 85, 90, even 100, carried their own clusters of call options. Under normal conditions, these contracts would seem harmless, out of the money, unlikely to activate, easy to ignore. But markets do not move in isolation. Once momentum begins, probabilities shift quickly. He saw the risk clearly. If the first wall activated and price accelerated upward, the market would not pause politely. The same hedging mechanics that forced buying near 80 would begin to affect higher strikes. Delta would rise, gamma would reappear. The feedback loop would restart at a new level. This was not linear progression. It was a staircase. Each step higher reduced the distance to the next trigger. Each trigger increased volatility. Each increase in volatility forced more aggressive hedging. The system became less stable with every move, not more. This was how cascades formed. The critical insight was that these effects were not driven by optimism or greed. They were driven by risk controls. Every major trading firm operates under limits, maximum loss thresholds, exposure caps, time-based rules. When those limits are approached, behavior changes instantly. Positions are adjusted, not for profit, but for survival. In a cascading gamma environment, those limits are hit faster than humans expect. He recalled historical examples, events often mischaracterized as speculative bubbles or irrational exuberance. In reality, many were mechanical failures of market structure. Short squeezes, volatility spikes, flash crashes, different assets, same underlying pattern. Concentrated exposure meets time pressure and thin liquidity. In this case, liquidity was the silent variable. Futures markets are deep under normal conditions. But depth is not constant. It depends on participation. As price accelerates, passive liquidity withdraws. Market makers widen spreads, algorithms step back, order books thin. The very firms expected to provide stability reduce activity to protect themselves. This creates a paradox. The moment the market needs liquidity most is the moment it receives the least. He understood that once price moved decisively through the first wall, participants would not ask whether the move was justified. They would ask whether they were exposed. Funds, short futures, would face margin pressure. Market makers, short calls, would face hedging pressure. Traders holding profits would face decisions about exit timing. Each of these decisions added friction. Some would rush to buy to reduce risk. Others would rush to sell to lock gains. The imbalance between urgency and availability would define price action. Not valuation, not analysis, urgency. The higher the price moved, the more fragile the system became. He also noted the role of time once again. This was not a slow-moving environment where participants could adjust over days. Expiration compressed everything into hours. That compression had magnified mistakes. Late reactions became expensive. Hesitation carried penalties. This is why cascades often appear sudden to outside observers. In reality, pressure builds invisibly. The release looks abrupt because the adjustment window is small. He saw another layer of risk that few discussed: correlation. As silver moved rapidly, it would not exist in isolation. Related markets would react. Volatility metrics would spike. Risk models would reassess correlations. Assets previously considered independent would suddenly move together. That reassessment could trigger defensive behavior elsewhere. This was not about silver alone. It was about what happens when a key input destabilizes models across desks. Many trading systems rely on historical relationships. Silver volatility within a certain range, correlation with gold, our relationship to currencies. When price breaks from expected behavior, those assumptions fail. Systems reduce exposure broadly, not selectively. This is how localized stress becomes systemic. He also understood why authorities watch these moments closely, not because they fear high prices, but because they fear disorder. Markets can handle trends. They struggle with gaps. A $5 move over weeks is manageable. A $5 move in minutes is not. The danger was not the absolute level reached. It was the speed. Speed turns paper losses into real ones. It triggers margin calls. It forces liquidations. It exposes leverage that was invisible during calm periods. And once forced selling begins in one area, it can spill into others. He did not assume this outcome was guaranteed. Cascades require activation. If the first trigger failed, the entire structure would unwind quietly. Contracts would expire. Risk would dissipate. The market would reset as if nothing had happened. That asymmetry remained. Calm or chaos. Nothing in between. What made the situation unsettling was how little discretion existed once movement began. Participants often believe they can react. That belief holds in slow markets. It fails in fast ones. When rules execute faster than judgment, preparation matters more than reaction. He saw why this setup demanded attention from serious decision makers, not because it promised profit, but because it threatened stability, because it tested assumptions about liquidity and control, because it revealed how much of modern pricing rests on deferred risk. The cascade risk was not theoretical. It was conditional, waiting, silent. In the next part, the analysis would move beyond futures and options and into consequences, because mechanical events do not end when contracts expire. They leave traces in physical markets, in supply chains, in pricing behavior long after the screens calm down. Understanding those consequences was critical because even if the cascade faded quickly, its effects could linger, and in markets, lingering effects often matter more than the initial shock. The consequences? When paper signals collide with physical reality. He understood that market events do not end when the screen stops flashing. Price action is only the first signal. The real consequences follow later, quietly, in places that do not move at algorithmic speed. Warehouses, supply contracts, dealer inventories, balance sheets. That was where the final risk of this setup resided. If the cascade activated, the futures market would respond first. Prices would move rapidly as obligations were hedged and positions adjusted. But futures are a paper construct. They settle overwhelmingly in cash. They represent promises, not delivery. When stress rises, the question is not what price trades at, but whether the promised asset can be sourced at that price. This is where the divergence begins. He knew that physical markets operate on different rules. Metal must exist. It must be refined, transported, insured, and delivered. None of those processes accelerate simply because a price moves faster. When futures prices surge on forced buying, physical supply does not suddenly appear. It tightens. Dealers respond rationally. They widen premiums. They limit quantities. They delay delivery. Not to exploit buyers, but to protect themselves from quoting prices that may be obsolete before settlement. In volatile conditions, certainty has value, and scarcity commands a premium. This is how two-tier pricing systems emerge. The screen price reflects paper urgency. The physical price reflects availability. When the two disconnect, arbitrage breaks down. Normally, traders would buy the cheaper market and sell the expensive one. Under stress, that mechanism fails because delivery risk outweighs price differences. He had seen this before, not often, but clearly. During prior disruptions, futures prices suggested abundance while physical markets told a different story. Buyers could see a low price but could not secure metal at that price. The quote became informational rather than transactional. That is not a healthy market condition. The risk here was that a rapid mechanical price move could expose an already tight physical environment. Inventories that looked adequate on reports might prove inaccessible. Bars allocated on paper might be tied up in leases or obligations. Supply that appeared liquid could turn illiquid overnight. This mattered far beyond traders. Industrial users rely on predictable supply. Manufacturers hedge input costs months in advance. When price discovery becomes unstable, planning fails. Contracts are renegotiated. Production slows. Costs rise unevenly. Strategic materials do not behave like consumer goods. Shortages ripple. He also considered the international dimension. Physical silver does not sit in one place. It moves across borders, responding to relative pricing and demand. When premiums rise in one region, metal flows toward it. That can drain availability elsewhere. If futures prices spiked while physical premiums expanded in certain markets, the pull on supply could become directional. Metal would move where it was most valued in real terms, not paper terms. That process takes time, but the signal forms quickly. He recognized that such dislocations attract attention from policymakers, not because of investor losses, but because of strategic exposure. Silver is not just an investment metal. It is an industrial input. It sits inside energy systems, electronics, communications, and defense equipment. Volatility at the margin can translate into cost instability at scale. Governments monitor these dynamics closely. They may not intervene immediately, but they assess risk. They consider tools, export restrictions, strategic purchasing, regulatory changes. None of these actions are taken lightly, but none are unprecedented. This was the deeper suspense. Markets often assume that structure will adapt smoothly, that participants will adjust and move on. But when an event highlights dependence on imports, on inventory, on counterparties, responses can be asymmetric. The goal shifts from efficiency to security. He also noted the psychological aftershock. Once participants witness a mechanical event, their behavior changes. Even if prices retreat after expiration, memory remains. Risk managers adjust assumptions. Premiums stay wider. Hedging becomes more conservative. Liquidity does not return to its prior state immediately. This is how regimes shift. The immediate move might last hours. The consequences can last months. He did not assume catastrophe. Many such events resolve without lasting damage. But the probability of lasting impact rises when the trigger is structural rather than narrative-driven. Stories fade, mechanics persist. That was why this setup mattered even if the most dramatic scenario did not occur. The mere proximity to activation revealed fragility. It showed how much exposure had accumulated quietly. It demonstrated how little room existed between calm and urgency. For serious decision makers, that information was valuable regardless of outcome. The final question was not whether silver would trade at a particular price. It was whether the system had absorbed too much deferred risk at a single point, whether efficiency had been prioritized at the expense of resilience, whether liquidity assumptions still held under compression. Those questions do not answer themselves in advance. They are answered in motion. He understood that markets rarely announce transitions. They reveal them, sometimes subtly, sometimes abruptly. The transition underway here was not about a commodity, it was about structure, about how modern markets behave when instruments designed to distribute risk instead concentrate it. The suspense, then, was not theatrical. It was analytical. Would the trigger activate and force behavior into the open? Or would it dissolve quietly, leaving behind a warning that few noticed? Either outcome carried information. One would reveal stress through action. The other would reveal stress through avoidance. In both cases, the lesson was the same. Modern markets move fastest, where risk is hidden longest. Those who focus only on price miss the signal. Those who study structure see it early. And those who ignore it entirely tend to learn about it after the fact, when choices are already constrained. As the window approached its close, he did not frame the situation as opportunity or threat. He framed it as a test of assumptions, of models, of preparedness. Because when the market is forced to act, it does not ask permission. It executes the rules it was built on. And the consequences follow, whether participants are ready or not.